This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, April 21st, 2015. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates macro developments. Therefore, the slides this morning will focus on our other three report areas of the GMT report: the global risk, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a single discussion. In this regard, I would like to discuss the following this morning: how we have a 70% consumption economy and what that means, how the federal government and Central Reserve are trying to keep this going as long as possible, that is, the consumption levels, a game of student loans and car loans that has emerged, and how the banks themselves are now very much attempting to protect their assets, and of course, what I expect to come from all of this. I closed last month with a thought that a U.S. recession may be a potential global economic tipping point. This morning I want to expand on that theme a little further and continue the dialogue from last month. I won't repeat a lot of the messages in last month's report, so I refer you to it. That is, quantitative easing, a failed experiment. Besides the central economic problem of consuming more than it produces and operating an unsound money system, the U.S. has the additional problem of being a 70% consumption economy. The 71% shown here in 2009 is a staggering level compared to the mid-50s for other indebted developed economies and only 35% for China. For decades, economists pondered just when the U.S. consumer would be tapped out. It was a futile game, as the U.S. consumer couldn't be stopped. Absolutely nothing seemed to slow U.S. consumption. It powered global supply expansion to meet this demand. China was the most obvious over the last 15 years. But maintaining GDP growth with a 70% consumption rate has put great strain on the investment capital because of lack of savings, trade, and current account balances. As you can see here, the current 68.4% is down from the last slide. Government spending has had to increase to compensate and to keep the economy barely growing with a current Q1 GDP marginally above zero. 70% consumption is especially difficult to maintain when we have secular trends like a collapsing middle class, well-paying jobs disappearing, and shrinking real disposable income. This is a long-term secular trend, which appears to be, and frankly, accelerating. Another long-term secular trend is a falling national savings rate, which borders on going negative again. Savings are the lifeblood of capitalism, savings which are required for investment into productive assets. Credit can only go so far as it comes with debt service payments and collateral requirements. Additionally, we have 75 million baby boomers retiring on a population of, let's say, 320 million, who will spend less in their retirement years and draw down their savings. No matter what you may conclude, it is imperative that the U.S. consumer not lose confidence and start to worry, thereby possibly reducing consumption and increasing savings. As a consequence, the government and its paid statisticians are incented to do everything in their power to make an ailing economy look healthy. We discussed some of those means last month. Increased credit is no longer increasing demand at a sufficient rate to stop producers from cutting production and new orders for raw materials. How much credit can be created before the new credit simply becomes ineffective? The exponential credit growth curve shown here has a limit, or we mutate into something other than capitalism as we know it today. I find the next two charts very telling. This chart shows that interest rates have had to be kept low to sustain even the deteriorating consumption rates we are currently experiencing. If rates were even closer to previous recoveries, do you think car sales would be anywhere near where they are today? Central bankers and the money center banks know they have no choice but to sustain these low rates to both keep consumption alive and make the debt of the government serviceable at lower interest rates. Lower consumption also means lower sales taxes and lower corporate profits. It would appear almost everything in America revolves around this 70% consumer consumption, or consumption that is now primarily consumer consumption. With over 50,000 manufacturing enterprises having left America since the dot-com bubble burst, we need to appreciate that corporate consumption of all those materials to run those factories has also fallen. Don't for a moment feel sorry for the banks that must manage on smaller interest charges. This is the second chart I said I found fascinating. They have carefully managed Washington and the Fed with their army of lobbyists. The chart here shows that despite falling rates, the bank's net interest income has steadily risen, and with ZIRP has been flat to marginally higher. The banks are not feeling the pain that pensioners and savers who are being decimated are feeling as they try and live on minimal income from their lifetime of savings. There really is no excuse for a chart like this, and it tells us Washington sold out to the banks, the great generation, and the baby boomers, and threw them under the bus to save bank profits. Really think about this chart along with the previous one. It is really the essence to me of the problem that we face, or the solutions we've attempted to solve the problems with, I should say. We now live in an economy of financial engineering. Wall Street is disconnected from Main Street. Remember, financial engineering fixes the bottom line, often at the expense of the top line, and that's what we have. We have a top-line revenue growth problem, which is shown in job growth and high-paying jobs, which power this consumption economy. We have falling top-line sales growth in the S&P 500, and last quarter, 90% of all profits were used for buybacks and dividends. Almost nothing was used for reinvestment. This is the equivalent of a farmer eating his seed corn. We now spend excessive amounts of the country's precious capital on existing interest and principal on existing loans. What is going on here is the government and banks are trying to buy time until a miracle happens or the current elected officials are no longer in power and can claim it didn't happen on their watch. There is actually a lot more going on than just that, as I have laid out in the Financial Repression series, where indebted countries use macroprudential policies for debasing the store of value of their currencies in circulation and thereby reduce over time the effective size of the government indebtedness. There may also be another game going on, however, and my associate Richard Duncan at MacroWatch has carefully laid that out. When the Fed makes a profit, it gives it to the government, that is, the U.S. Treasury. The Fed has given the U.S. Treasury $500 billion since 2008. Here's what's going on, according to Richard. The Fed creates money and buys government bonds. The U.S. Treasury Department pays interest on those bonds to the Fed. The Fed then turns around and gives almost all of its profits to the Treasury, including the interest income it earns on the government bonds it owns. That means the Treasury is not really paying interest on those bonds. In other words, the government bonds owned by the Fed has been effectively canceled, or as Richards says, liquidated. As long as the bonds stay on the Fed's books, This shell game of accounting could go on indefinitely, effectively creating debt liquidation. It comes with some major downsides, which I won't get into here, but suffice it to say, the government wins if it can buy more time and keep things relatively stable in the interim to allow this to happen. To keep the gig going, since the 2008 crisis, the bankers had to come up with new sources of credit creation based on the implosion of securitization and housing mortgages. Don't get me wrong, they are both still alive, but nowhere near where they were prior to 2008. And it's that run rate which is important. I drew this diagram in 2013 with how I felt then credit growth would be created going forward. We are now more or less in that box, with the growth coming from car and student loans. What is very telling is the vast majority of all that growth was backstopped by the government through things such as Sallie Mae or Government Motors, the former GMAC. We are all well aware of the dramatic increase in student loans, but we somehow separate it from the 2008 crisis. Look at the right chart to see when the government started backstopping these loans, not the private sector. Like the mortgages in 2008, they are passed off to the government to hold the bag. There are already cracks appearing in student loan delinquencies, despite about $500 billion of the $1.3 trillion now being reclassified as in deferment or forbearance versus delinquent or in default. Just more accounting games to avoid the reality that these loans are never going to be repaid. In my opinion, the business cycle has begun to turn, and it is only a matter of time before both car loans and student loans will hit a wall because, like mortgages in 2008, non-performing loans will accelerate. This actually may already be underway, and the banks would be well aware and worried about that if that was the case. And I think this begins to show here. Everything other than student loans and car loans is already in contraction or simply never recovered from 2008. Thank God for taxpayers once again accepting the liabilities with this increasing credit. Former United Kingdom Prime Minister Margaret Thatcher was famously quoted as saying, "Socialism is about spending other people's money until they go broke." In many ways, democracy is similar in that we feel this taxpayer indebtedness is not going to be our problem. I was interviewing Miss Shedlock recently, and he was ranting about a $600,000 house in Illinois coming with a $14,000 to $15,000 annual tax bill, and basically he was buying his house all over again every year. A listener wrote in disbelief because they claimed in New Jersey it was twice that. Property taxes are climbing, and remember, in America, property taxes are the domain of the local government, from city, town, and municipal. And they can't print money like sovereign national entities can. Property taxes are climbing, and soon your house may possibly be a major tax liability for you. And I'm just giving you one example of the realities of what this indebtedness are going to mean going forward. As I said, the banks would already see this and would be forced to begin to take some actions if I'm correct. Here is a chart that graphically shows exactly what is going on today. Banks have stopped credit while government-backed credit continues to flow. I thought this National Association of Credit Managers report spelled out clearly what I suspected was occurring. The rejection of credit applications index has exploded downwards. It's the biggest spike in credit application rejections on record. The overall slowdown in credit and heightened credit concerns have been with us for a while now, and I've discussed it previously. The banks are aggressively battening down the hatches. I talked last month about liquidity problems and high-quality collateral shortages. This is a problem. Remember, in 2008, it was about the shadow banking system and a sudden liquidity problem. The $72 trillion global shadow banking system is about borrowing short and lending long on the expectations that short-term lending is readily available. In 2008, a collapse in asset-backed commercial paper, when money markets, quote, broke the buck, brought liquidity to a halt. Today, it is not about asset-backed commercial paper. Today it's about repos, collateral transformations, and rehypothecation. Same problem, different terminologies, and a different orientation. But if you look at this chart, nothing has really fundamentally changed. The problem is still there, but at this time it's not sovereign, it's global. I have shown charts previously that would indicate a U.S. recession later in 2015 is a real possibility. Here are a couple of charts I may not have shown. This chart from our partner Ronnie Storfel at Incrementum shows that the ratio of capital versus consumer goods production overlaid on prior recessions is suggesting quite strongly that we are entering a period that has a high probability of a recession coming. The credit summary chart is also very telling, and it summarizes a number of elements here on the left of credit. I have found that credit markets always warn of danger first. I believe this is the sort of thing the bankers are looking at, and have always looked at, and would become increasingly worried about. The divergences are more than just a little dramatic. I believe another thing the bankers are worried about is the growth in exchange-traded funds, what's called ETFs, that are based on foreign holdings. Increasing geopolitical tensions could trigger rapid selling shifts in these products that are being bought by all manner from funds to individual traders. We have a world of professional fund managers and non-professionals, as I said, using these tools in an expanding fashion. And like in 2008, when the chief financial officers suddenly decided to move money when the buck was broke on money funds, and $5 trillion suddenly was starting to move, panic set in and forced Bernanke and Paulson to go that night to Congress. Well, it could be something with concerns about recessions, not in the United States, but emerging markets that would start to trigger equity market dislocation, bond market dislocations, etc. Having said everything that I have, I simply say don't worry. Never forget throughout this turmoil, they will print the money. And as long as they're printing money, these assets, though they may correct, will continue to increase. The question is, for how long? Because this game is a finite game. In closing, I would like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2015 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.